Folks, as a real estate channel, one of the things that I have to stay close to is not only the housing market, but the lending market. And because you look at the lending market, we've got to talk about rates. Mortgage rates kind of are influenced by the 10-year, which kind of influenced by the Fed. We got to have this discussion. Let's talk about it with Taylor from Life Goal Investments. How you doing, buddy?
Doing great. Thanks so much for having me. We're in a weird environment right now because, to your point, when you say the 10-year treasury rate kind of dictates, historically, it's been a really good dictator, but there is a massive spread right now, a historic spread, honestly, between the 10-year treasury rate and where mortgage rates are. And so it's an interesting thing where the banks were quick to raise rates or mortgage rates on the rate increases of the 10-year treasury. But now that they're coming back down, they aren't quite as quick to reset them lower.
Shocking.
Yeah, exactly. So right now the 10-year treasury trades at 341, and you could give a better idea than I can as to what the 30-year mortgage.
Yeah, I think the 30-year mortgage rate last I saw was about 6.4, maybe it was 6.38, something like that. Mortgage News Daily, if you want to go check it out, publishes it once a day.
So that's a 3% spread between those two numbers, guys. That's massive. That's a historically wide gap.
Yeah, not normal. One of the things that I think a lot of people don't realize is the Fed could raise rates, which I think will happen on May 3rd, and mortgage rates could go down. Just for example, go back and look at their last meeting. They raised and mortgage rates went down. Taylor, how can that be?
Yeah, because what's going to play out if they continue to raise rates? If inflation continues to drive rates higher, what the market is going to perceive that as is the Fed has to remain aggressive, raising rates, increasing debt obligation costs, and that's going to force us into a recession, and that forces the back end of the yield curve lower, and mortgage rates are largely predicated on the back end of that yield curve. So again, you could have the front end going up by the Fed increasing rates, but the market perceives that as that's going to force us into a recession and will bring down mortgage rates along with that 10-year treasury, which is the back end of the treasury yield curve.
Yeah, so let's talk about this front end, back end. Again, people may not realize it, if I'm wrong, please correct me, but the federal funds rate, this thing that we talk about every 6 weeks or so, that's an overnight rate. Is that correct?
Correct. Yep, that is correct. That is what the banks lend each other money at.
Yeah, but again, it's an overnight rate. Talk about, less than 24 hours, right? It's a
correct. But so when you think about the treasury yield curve, you think about 2-year bonds and bills, which are shorter than that, treasury bills, which are shorter than that. That is largely influenced by the Fed's decision, almost directly. The back end of the yield curve, call it 5, 10, 20, 30 years out, is dictated by two things: the rate of change of economic growth and the rate of change of inflation. Yeah. Those two things are what are determining the back end of the yield curve. And guess what? If the Fed continues to raise rates on the front end, driving the front end of the yield curve higher, the back end is going to say this is a slowing mechanism for inflation and for the economy. That's why you get that inverted yield curve. And that's why an inverted yield curve has predicted every one of the recessions, because the Fed gets aggressive on the front end, drying up lending, and the back end falls because we're going into a recession, and you have that inversion of 2-year treasury notes trading at higher yields than 10-year and 30-year treasury notes, which does not make sense in a normal environment.
And then the other thing that goes on all around this, right? There's these people talking about the market. They're usually referring to the bond market. The bond market and the Fed, once again, are in vastly disagreement. I don't know if it's still true, but over the weekend, the bond market was calling for 3 rate cuts this year. 3 this year. And Powell has said, not happening.
0. He says 0. So what does that mean? So if the market is pricing in rate cuts, what is the market saying? Why would the Fed cut rates? The only reason the Fed cuts rates is if it becomes crystal clear that the economy is slowing and needs stimulation. And that's when the Fed cuts rates.
Yeah, a lot of folks, again, I'm active on Twitter now at One Rental at a Time, are saying, hey, Michael, you don't get it. The Fed's going to cut. The Fed's going to cut. I think they've been trained, right? The Fed put, which I think was first done by Greenspan and then Bernanke and then Yellen. I think Powell's going to kill it. Not many people understand that. But But I want to be clear. People treat the bond market like it's never wrong. You and I have had this debate now for over a year, and you've been on the side of the bond market, and I'm on Powell's side. So let's be clear. I think the bond market's like 0 for 3 or 0 for 4. They've been wrong all year. So to talk about the bond market being right
incorrectly, and you have been correct on, is they have said, we don't believe Jerome Powell. We don't believe what he says. So every time there was kind of a intersection where it wasn't clear and obvious what the direction the Fed was going to do, they raised more than expectation. They raised 50, they raised 75, and the market said, no way, they're not stupid enough to do that because it's clear that the economy is slowing down. And the Fed said, listen, we've told you time and time and time again, inflation is what we are focused on, and we'll correct it.
Yeah, one of the things that I think is going to happen, I've put this out on the Daily Financial News a couple of times, is I think Powell is going after the billionaires, right? You've probably seen it, Barry Sternlicht all over CNBC. I got to tell you, when a billionaire brings PowerPoint to CNBC, that's kind of a sign of stress. That's the kind of, hey, dude, my portfolio is illiquid. It's a duration mismatch and I need some help. That's what I think that's a sign of. But I think he was very clear at Jackson Hole 8 months ago. I'm coming for you. And if you didn't listen, shame on you, Barry.
Correct. You're 100% correct. Yeah. Billionaires are usually sipping cocktails on CNBC on their yacht. They're not bringing PowerPoint presentations, making the case that we need to decrease rates. And here's why.
Kind of a red flag.
That's
and then the other thing, the other thing I think has happened is I think some politicians in power are going to come after him. I think Jerome Powell, if he breaks the Fed put, which I think we're right on the cusp of getting painful. I think he's going to become the most hated man in the country. Politicians are going to come after him. Billionaires are going to come after. It'll be like nothing we've seen. I think that's right in front of us.
It's funny. He catches so much flack, and it's just because the end consumer, retail, whether it's investor or just average layman person, doesn't understand the dynamics. If inflation gets away from us, guys, that is actually a bigger problem than a recession. It affects everybody. A recession, granted, it affects everybody as well. And a couple people, I shouldn't say that, maybe a couple million people lose their job. And we look at that and say, that's terrible. And it absolutely is. But that is affecting a much smaller percentage of the country than runaway inflation does, which affects 100%. Price stability is so darn important. And that's what they're focused on right now. And they're going to do it at the detriment of the labor market. It is what it is. And my opinion of what Jerome Powell has done he's actually done a pretty good job, my take. Now, granted, you go back to the beginning and say transitory and take those words out of his mouth. Like, that was a bad look. I totally get that. And then the biggest mistake, I think, by the Fed was to continue to buy billions of dollars of mortgage-backed securities in the face of a white-hot real estate market.
Couldn't agree more.
That was the two big mistakes that they made. They stayed around with rates too low for too long. They spilled money into the bond buying environment in the mortgage-backed security space, which was very healthy at the time. And then I think on the last note of it, they've done a good job. They've done what they needed to do by raising interest rates over time. There's no other way to handle this.
Yeah. I think at the end of the day, what I don't think a lot of people realize is the Fed put has helped billionaires, only billionaires.
Right.
And by breaking it, I think he's gonna make because again, part of capitalism is you gotta suffer losses when you make a mistake.
It's a function of how the system works, right? The business cycle moves like this, and you need troughs in the business cycle. The market does not work without it. Things get away from us. Inflation runs away. It's something that has to be controlled, and how they control it is with interest rates. And it is a blunt instrument. It's like taking a ramrod and slamming it into the side of a door of a car. That's what they have to do.
Yeah. So again, I think we're getting into it. I think we get to the terminal rate May 3rd with the final quarter point, which will take us to 5 to 5 1/4. It's been my call for over a year. I think that happens May 3rd. And then I think Powell holds on hard all year. I believe his intention right now is not to cut. If he does cut, I got to be really clear. If Powell cuts, you aren't going to like the reason why.
Correct. So I agree with you. Powell stays put. I don't think that we get a movement in May. And that's contrary to popular belief right now. And maybe I'm more that naive market that we talked about before, and you're more of the reality of things. And maybe I'm letting my own opinion influence what I think should play out in doing so. But I think we have a whole month before that data starts, or before that decision's made. And I think a lot of data is going to get printed between now and then. And I think that will give them the reprieve they need to not have to continue to raise rates.
Yeah, I think the only hope for no raise, you'll get me in that camp if we print this Wednesday CPI sub 5%. I'll do it there. I mean, I do see a possibility. It's not high. It's not high, but again, do you think he holds all year, even if he doesn't raise May? Do you think he holds pat, or do you see a cut in December?
Yeah, it'll be interesting. I guess the way I perceive what's going to happen in the economy, I do think that likely a cut comes later on this year. But again, this is all incredibly data dependent, and the data has to be nasty because he's saying that he's not going to. So it's going to have to be, again, aggressively poor data in order to drive that. And I think that, admittedly and unfortunately, I'll caveat one more thing. Like, I have been negative on the economy and the markets now for an entire year. I'm a long only manager. I want to be bullish on the markets, but I'm not going to BS you on the other side. I got to tell you what I see in the economic data, and it shows that things are continuing to slow.
Yeah, and last week, folks, in your playlist, we talked about one of your ETFs. You're kind of at the lower bound, right, of equities, because again, you don't have a great feeling about what's going on, and you're not going to put stuff at risk. So I thought that was a fun conversation. Where can people find you and follow you?
Yeah, follow us at Life Goal Investments. We're on both TikTok and on Instagram. You'll get a video a day, sometimes 2 and 3. And when the market gets nasty, you'll get a higher number of videos, because I know you guys need to understand what's going on.
Yeah, give him a follow today. Tell him he came from One Rental at a Time. I would appreciate it. Thanks, buddy.